Hello traders, in today's video this is going to be a video that I am super excited for and I've been doing research on for quite some time. So for those who didn't see my follow the index video, that's a video where I showed, I feel like I've said that word like 25 times. That's try to find like a synonym for video. That's a video where I showed you guys how to make good risk reward decisions based on the difference between the spot price and the futures price of various coins on FTX. What we're going to be doing now is I'm going to be giving you guys a free, more streamlined, easier strategy to do this on any exchange that you so desire. Let's dive in. So before we go in, I do want to show some trades that I made just to show you guys how your trades might look if you do decide to do something like that. So I'll switch over to here. So how can I get there? Okay, so this is Holy Perp. What I noticed actually last night, and I was able to capitalize on this, is I saw that the index, this blue line, was leagues higher, much higher than the futures price. This must have been a glitch or something, but it was 25% higher. I was able to actually double my entire futures trading account. Yep. The way I was able to do that was I just bought because I saw the index was insane. I know I had a crazy risk reward because I knew that the futures price typically climbs up to the index. I earned a crazy amount of funding, the funding rate, after I bought with no hedge, and then the price just slowly creeped up. Look at that. And this might not seem like a lot, but it's a lot more than you think. And on high leverage, it can be a lot of money very quickly. And it was going up, like 1% an hour. And then not only was it going 1% up an hour, it was paying out funding that was like 0.75% an hour. So on leverage, this was insane. It was an amazing trade, and I got very lucky that I actually got out before this happened. But what I want to show is just how changes in the index can have such a powerful effect. And if you're not trading like this, I think that you're really shooting yourself in the foot, obviously. So you might say, okay, so Bennett, how would we know when to get out? Because this is clearly beautiful. When the blue line, the index, is this much higher than the futures price. Well, look at this. When the index actually fell much lower, even the index fell below the futures price, you would have still had an opportunity to get out and still be in profit. The market only went down about 4%. Holy Perp only went down about 4% here. And had you shorted or sold even at the very low here, I mean, you would have made plenty of money. Really, the reason this fell is incredibly simple. The index dropped dramatically because it probably just went back to its normal value instead of some weird glitch value that must have been happening on Holy Perp. And when that happened, obviously just stabilized, and then nothing exciting happens at all. It just kind of climbs around, blah, 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 nothing happens. This is such an easy trade. I think that a monkey probably could have done it. There's really no complexity besides if blue line very high, buy futures. If blue line low and relatively low to the futures, sell. It's like just like that. It's that simple. Now let's talk about what trades you can make, because these are all potentials that I've been looking for, and I'm going to share them with all of you if you so desire to do anything about them. So let me go back to this. Perfect. So what you're looking at here is actually a list of every single perpetual market on within cryptocurrency, within the whole community. And we can see the predicted funding rate on every one of them. Now, I've highlighted a few that have very insane funding rates, and I want to show you guys really what that means and how we can play them. Now, remember, this is going to look a little bit different and maybe a little bit more complex than what I just showed you, but I promise you it's really not that hard to understand. When this is very red, that means that the funding rate is very negative. When the funding rate is very negative, that means that the spot price is much higher than the futures price. If the spot price is a lot higher than the futures price, typically the futures price will climb up to the spot price. I.e., when funding is very negative, typically price goes up. When funding is very, very positive, typically price goes down. This also happens for a few more complex reasons, but I don't really want to get into them. Let's go over a few of the best examples ever, which is when price is in an uptrend and funding goes really negative. It's just such a good sign. I mean, I'm talking about short-term trading only, though. When you're watching these kinds of techniques, just know this is very short-term, within a day or two. These are not trades meant to be held for more than a day or two. That would be very dangerous. Even if funding's on your side, even if the index is on your side too. So as you can see here, price stabilizes and consolidates for a long time, right there. And funding gets very negative. That means that the spot rate, the index price, is going higher and higher. Futures price is staying low. That's a golden opportunity, golden, really, to have bought here. And you can obviously see what happens next. It just pops up so much higher. What happens now? Look at what the funding rate's doing. This is telling me right here, if the funding rate is getting smaller or closer to zero, that means that the index price and the futures price are converging. And that means that people are probably getting a little bit more bullish, which for us is more bearish. So a drop in negative value is seen to me as very bearish. A rise in a negative funding value is seen to me as very bullish. Okay? So we can see that it starts to drop right after, well, right around here, but it really starts to drop especially after this. You can see it right here. And this is where you would need to get out. This is just like really bad for anyone who's long. And then price goes lower, of course. So that's a really good example of that here. And then we can see probably the best example right here. Yeah, I think this is even better. Price fell a lot, so people were very bearish. Then the index price, I know you can't see it, but I'm referring to the index price via the percentage difference that's indicated to me by the funding rate. This is very negative. Index price, spot price is much higher than the futures price. Here we can see that the index price was getting a lot higher than the futures price. Look at that. And this sign right here of this getting very, very negative, this was a sign that you should probably be buying. And had you seen this and then been like, okay, this went from like an average of 0.4 to like 0.8, then had you bought for a quick little scalp, again, these are very quick, you would have gotten a very good percentage. And this isn't even the best example. There are many far better examples than even that. So I'm going to show you guys that. Dora USDT, no, we're not talking about the Explorer. We're talking about the cryptocurrency. I thought that was funny. Hope you guys did. So this one's kind of a mess. I do know that. So this should be taken with a grain of salt because there's not a lot of liquidity. But we still do see very similar themes present. What you're looking for is changes in the predicted funding rate. So when the funding rate gets very, very high or very, very low, very, very positive or very, very negative, that's when we need to act, okay? Because that's the point of where the best trades come really quick. Let's give an example. Right here, price was rising, right? And then we see the funding rate just jacked up. That's telling me that the index price, the spot price, is much cheaper than the futures price. Futures traders are buying at a much higher rate. This is just has short written all over it. Had you shorted, you would have been probably pretty good. Same here. What happens the very second, this is the best example of the video for sure. Like very clean, incredibly clean. Look at this. Price consolidating, not doing anything. Funding rate gets negative, you buy, let's say. The very second price gets to a top, it gets positive. You short, you would have had a perfect trade because the funding rate's positive here. If you had shorted right around there, you never would have been out of profit for a long time, and you would have had that. So pretty good. Had you shorted here and then waited for a spike in negative funding, short here, you would have gotten out probably around here. So that would have been pretty nice too. But I think you guys get the idea. Here's another one. This is not the best, but like the funding rate got very, very negative. Not very negative, but it got pretty negative here. And then had you bought at that little low, price went up. And now probably shorting is probably a little bit better. It's more likely that this might fall a little bit. So that was Dora. Again, not the Explorer. Don't copyright me, whoever owns rights to Dora, please. No, thank you for that. This one, I don't think there's really much to say. I just want to pull up this example because it's very erratic, but I don't love it. Because this kind of strategy, I think, is going to work a lot better with coins that are a little bit more liquid than something like UMEE. So this one I would, give with a grain of salt, even though I pulled it up. This is probably not the best. Well, actually, it is the best, but this one is absolutely fascinating. And I'm going to narrate everything that just happened because there's a lot of craziness going on here. Let's first go with when the price of XCN on Huobi almost went to zero. So this rate... look at this. Yes, the price fell 96%, but we're not really interested. These funding rates are barely negative. Ignore it here. What gets interesting is what happens after the fall. So we go from a price of about 0.13 to an average price of 0.007, so almost nothing. The funding rate gets positive, which is a really scary sign because that means that the spot price of XCN is still higher than the perpetual price. That's a sign you should not be buying. Watch what happens here, though. The very second that price begins to go up a little bit on the hourly, look at the funding rate. The funding rate gets incredibly negative. Now, had you seen this, well, a few things would have been indicated. This basically means that spot traders, the index price is way higher than the futures price, that many futures traders are likely short because they're selling it, at a much lower rate than spot, probably to hedge. Had you bought right here and been like a contrarian and seen this and then bought right there with a very negative funding rate, not only would you have gotten, what is this, negative 3%, that means you would have gotten paid 3% every 8 hours. That's insane. And on leverage of, let's say, 5x, that's 15% right there. But this is a very dangerous trade. Had you bought right here, you would have gotten like a 75% return. Of course, maybe 100% even. Let's see. You would have gotten almost like an 100% return if you had just seen just how negative things had gotten. This kind of trade would have to be very low risk, though, meaning you wouldn't want to use a lot of your capital because there's just so much volatility and lots of opportunities to get killed, like that right there, that wick. And then as you can see here, let's go look at what's happening. The funding rate's kind of chilling out, which is telling me I'd probably rather short this because I would much rather see this very, very negative, meaning that the spot price is very, very high relative to futures. This is indicating a little bit more of a short to me, but that's just me. Looking at way back when, it's just kind of not that clean. There is a little bit of prettiness because you can see as the price is going up, the funding rate gets more and more negative, which is a sign to keep buying, and that would have worked out pretty well, had you bought there and enjoyed a 30% return. What I don't like, though, is that it peaks at the top. What this means is that the spot price was so much more expensive than the futures price right here, but it actually, typically that'd be a sign to keep buying, but here it actually formed a market top, so that would have been not too pretty. This one is probably just so not liquid that I don't know how much I could do with this, but buying anywhere here would have been really nice because if you had bought let's say here, you get that 40-50%. But a lot of this volume came in when this craziness happened, and that's what I want to focus on. So as you can see here, whether it's Holy Perp, which is the first coin that I showed you, or it's any of these random coins, really what I like to look for and what you could potentially look for are coins that are smaller to mid cap but aren't very illiquid, have some liquidity, have some 24-hour volume. Because coins that have, let's say, I don't know the number, maybe under like 1 million, 24-hour volume should never be traded. Just not a good idea at all. Because if you get in, it's going to be pretty hard to get out. But coins that are a little bit bigger, like OGN, something like that has $317 million in 24-hour volume, can give very reliable signals and really good risk-reward plays, kind of like what I took with Holy Perp. And going back to OGN, which is probably the easiest and frankly the best example because it's the most liquid, as you can see here, it's been very, very clean. Just looking at the change in the funding rate, when there's a sharp drop in the funding rate, typically a good time to buy. Now, of course, you do know that this strategy is not always going to work. We need to pair this with other things. You need to have good rationale of why you're doing the things you're doing, again. Because you can see here the final jump in the funding rate was at the very market top. So we do need to be careful. But just because something doesn't work 1 or 2 times doesn't mean it doesn't work the majority of the time. So I do think that looking for large funding rates, whether it's really positive, meaning that the spot rate is much cheaper than futures, or it's very, very negative, meaning that the spot rate is much more expensive than futures. Typically, futures prices chase the spot price. And when you get fortunate or lucky enough to spot one of these, where the best example is when futures and spot are like this, and then the spot rate goes like that. But then futures price kind of just chills right here. That's a really good sign. And that's what happened on Holy Perp, because the spot rate stayed up here, and the futures price just kind of climbed up to it. And that's what makes this kind of strategy so easy. Kind of black screen. It's kind of weird. Okay, now my computer's glitching out and telling me to stop the video. So you get to just see me now and no more charts. that's going to do it for this video. I hope you guys got something out of this. I think that this is one of the better strategies that I've ever come across. It just seems like it's very intuitive to me. But if you guys want any more clarification, you can always private message me or leave a YouTube comment. Happy trading, and I'm looking forward to seeing you guys in the next one. Bye-bye.